Good morning, everybody. Welcome to the ARMR Report morning meeting. Thank you for joining me again. Great to be back on the desk with you after what was ostensibly really 4 days off the desk, family vacation and all that up to St. Augustine. So, what was essentially the worst 4 days to be off of the desk the entire year. This guy right here was off the desk. So it was crazy, but I'm happy to be back. And I'm looking forward to this conversation and getting back to the process of building our net worth, protecting our capital, and doing all those things. So it's the ARMR Report. Let's don't forget, this is the process right here. It's a virtual hedge fund trading floor, guys. You're all portfolio managers of your own assets. And what we're doing is following the 3 essential stages, doing our research, using a whiteboard for that, using algorithms to execute, and then risk management rules to protect ourselves. So I'm going to share with you how I run my own personal portfolios, right? There's 4 portfolios at the ARMR Report: index only, dividend portfolio, a growth portfolio, and an ETF portfolio. So our job is to I share with you what I do in those 4 portfolios. Your job as portfolio manager on this virtual hedge fund desk is to figure out how to construct a portfolio that suits your risk tolerance, your goals, and all those things, okay? We use ARMR algorithms to help us execute, telling us when to commit capital, when to take it out. Don't forget, this is especially important right now, so we're going to unpack what happened in the last 4 days. These are probability algorithms. These are not neural networks trying to guess what's going to happen in the future. This is simply getting us on the right side of probability over and over again when rewards worth risk. Even a strategy that's right 8 out of 10 times is going to lose money twice. So we need risk management rules to protect ourselves. And what just unfolded is proof of why we need to follow those rules strictly if we're going to make this investing process work over a long period of time. Okay. So let's dive right in. Don't forget first, this is what I want to talk about first, because when the market implodes like that, and maybe you took a couple of cuts in the last 3 or 4 trading sessions, totally possible, okay? You have to look at the bigger picture. Our job as portfolio managers in the hedge fund world, when I was running hedge funds, our job is to outperform the S&P. We call it alpha, right? How much are we outperforming the S&P? Well, the S&P, the NASDAQ, all these indexes, they're down 20, 25, 30%, in some cases 75% in the last 12 months, right? All right. So if you got clipped, I don't care what it was. Let's say you lost 5% in the last couple of trading sessions. In the grand scheme of things, so now your portfolio is what, flat for the year, maybe? The alpha you've got is huge. So you're outperforming dramatically. Sometimes we get so myopic about what's happening. We follow each trade and we have a couple days that don't work, and there's this feeling of panic or fear. All of those things are emotions designed to get you off the bus, to get you off your track, and will result in total underperformance and frustration, and you'll end up just quitting. I just can't do this, forget it. All right? So take a step back and say, wait a minute, I'm wildly outperforming the indexes, right? We're going through one of the most difficult bear markets since 2008. And your assets are intact. Some of you might be making money for the year. Some of you might be down 5% for the year. At the end of the day, in a market like this, in a long-only strategy, which is what we really are, now's the time to protect capital and stay right around break even, waiting for the next wave of opportunity so that we can see our net worth to go to new highs before the S&P even rallies 10%. It'll still be down 10% for the year, and we'll be making new highs for the year. So that's the strategy. That's the big picture strategy. Don't get caught in the frustrations of a tough couple of days. If you're a real portfolio manager, if you're really trying to run your own capital, you're going to have to live with those swings. So learn to deal with the emotions. And the best way to do that is have perspective on what you're really trying to do. All right. And that is long-term performance, protection of capital over a long period of time, giving yourself an opportunity to increase net worth when the window's open. That's our job. All right, so those are some of my thoughts off the top of my head. I always like to really, try to get myself back into the groove. This is my first full day back on the desk since Wednesday of last week. So first thing I want to do is go just take a look at what the market's doing, because I hear a lot of chatter about, is it time to hedge? Should we be shorting? Let's hold VIX and all these other conversations. And I submit to you that conversation needed to be had right up here, or and really it was Thursday in the last hour Thursday, and I was literally incommunicado. Okay, I was in St. Augustine Thursday in the last hour, and in St. Augustine, they have cell reception, but you can't get any other data on your cell phone. It was the most bizarre thing. So I was in the dark trying to figure out exactly how to execute, and I couldn't get on here and chat with you guys. But had I been here on that collapse right there, taking out the lows, hitting the stops, that's the time to have the conversation. Should we be hedging? Okay. Then the next day, you can see on Friday, we turned risk monitor red. So market closed right down here, and it's okay. There's a last hour of trading. So you could say, okay, let's see how tomorrow morning opens. Well, it was a gap down. That was it. Just took the whole, risk monitor red in here. So by the end of the day, Friday, we're risk monitor red, and the market implodes on Monday. But the time to discuss getting long VIX and getting short anything is up here. After the market implodes, you have to ask yourself a couple of things. You have to remind yourself, our job is to get on the right side of probability when reward is worth the risk, over and over again. Okay. So the probability of shorting, of hedging, of doing those things now after the market's collapsed right in front of a Fed meeting is a low probability bet. Now, can it work? Can you go into a casino, roll snake eyes? Sure, it might work. And don't let me stop you if that makes you comfortable. Okay. But that's not how I run money. I would rather be cash. My conservative portfolios, 100% cash. That happened on Friday of last week. We avoided the collapse yesterday. We're sitting in cash. I'm not trying to hedge. I don't need to hedge. Cash is king. Okay. Some of my conservative portfolios have, a small portion of capital in some dividend stocks like pipelines, right? Maybe we have 10% of our portfolio in gold and silver bullion. Okay. But that's it. So large cash positions, I don't need to hedge. Aggressive portfolios, they got clipped a little bit more, right? In my aggressive portfolios, I was, probably up a couple percent for the year. I ended up down a couple percent in like, two and a half trading sessions. And that was ugly and fast, but it happens. We're hovering around break even, protecting our capital. One of the worst bear markets we've seen in years. Window will open, take us right back to new highs. Okay. But even in that portfolio, now I've got a large cash position there, more than 50%. All right. And hedging right in front of a Fed meeting when everyone expects 75 basis points and the market's already cratered, probably not the best bet unless you are saying to yourself, I think the market's going to crash. Okay. And what I've discovered, I was talking to my wife about this on the cruise up to St. Augustine. We were, chatting about life in general. And even though I was on a cruise, I was, obviously can't get away from thinking about what you and I do together. And I was saying to her, I love guys like Hugh Hendry and Northman Trader, and there's a couple of guys. I mean, Zero Hedge I stopped reading years ago, but all of these guys have great angles. All of these guys are really smart people, and they're all always calling for like Armageddon, market collapses, world falling into brimstone and fire. I mean, and my discussion with my wife was like, what's the point of living life like that? If you're always calling for the end of the world, what's the point? I mean, no, this is like an existential question or a real philosophical question. Like, what's the point of always living life expecting Armageddon? Like, if it actually happens, first of all, you're on the wrong side of probabilities, okay? Statistics will show you that doesn't happen. Pendulums swing, things get out of hand, people get scared, then it goes the other way. Markets make new highs, okay? The strength of the human spirit is very hard to snuff out, okay? So things will recover. But at times like this, it's like those loud voices of dissent, of negativity. People forget that they've been calling for Armageddon for years, right? They've been wrong for years. And so, like, what's the point? When they're finally right, nobody's around to hear them, right? I mean, if they're finally right, the market's collapsed, nobody's watching CNBC, people are running around fighting each other for a loaf of bread. So, I mean, who cares? I'm just saying, like, what's the point? So I'm a pessimistic optimist. Like, I recognize the concerns. I try to discount them. I care more about protecting my capital than capturing upside. That's what the ARMR Report's about. But I also balance that with statistics and probabilities. They heavily favor the market recovering, the Fed getting on top of inflation, the world not coming to an end, right? But also, it's like, I just want to ask, if you're one of those people, does it make you feel good in the morning? Like, what's the point? That's just a question I had for you, just a thought in the top of my head for this morning. So if you're using the negativity to help you protect capital, okay, I get it. But if you live in that negative space, to what end? So you hole up in a bunker? I mean, you end up, your quality of life is just a lot. Your quality of life is very depressing. And for what? When you're finally right, what? How does that make you feel if you're ever right? And you've missed all the beauty in life. That's all. All right, now I'll get off that conversation. It's a little philosophical rant for you. So what are the things that are on my mind this morning? I look at this chart and I say, market's already collapsed. It's down to the bottom of this, these three red bars right in here, right? So these three red lines, these are the different trend lines the market's following. So the market tried to go risk monitor green and failed at the 50-day moving average. That's what this line is here. I was hoping we'd get that push up to the 200-day. When you break down at the head and shoulders top, usually you make it up to the neckline, which would have been the 200-day, before really imploding. But this market's so weak, it couldn't even get past the 50. That's disturbing. The speed of the decline was really disturbing. So now I'm going to get into negativity, but I just wanted to couch it with that philosophical question so we don't fall into the abyss of negativity, okay? But this is how negative it is. We couldn't even get to the 200-day. We failed at the 50-day, and we had this unbelievable speed of implosion. So I'm going to just fix that. Someone's telling me my camera's a little bit off. Hopefully that's better. Okay. Anyway, so the speed of the implosion is disturbing, and we have the Fed meeting coming up. But I do want to show you how the markets move right down to this first and most aggressive trend line. So my guess is the market is done selling off right there, but it has been disturbing. There's no way around it. And we get the Fed meeting on Wednesday. And so everybody's expecting 75 basis points at this stage. And I think we're probably not going to get 75 basis points, or if we do, the market goes up on that. So I think it's a win-win no matter what happens on Wednesday. By the way, that's my call. I'm making it right now. The market's up after the Fed meeting on Wednesday. It'll be just a big sigh of relief. The market overreacted as usual. Then we just got the producer price index numbers out. And, it really depends on the headlines you're reading, because I see some headlines talking about, well, worst number ever. But you see the numbers coming in equal to or less than expectations. So the market's rallied on that news. So we're in this event-driven market where the CPI number was hot, so the market crashed. Then we'll get some economic numbers that aren't as bad as people think, so the market will rally. It's just a tough bear market, guys. I want to say this right now. That last decline right there said to me, this is going to be an extended bear market. So now we have a well-defined head and shoulders that we've been talking about in the trading desk for a while. Okay. Breakdown. Notice how the market stopped right at the Fed hawk day low. So this was May 4th Fed saying, oh my God, we're behind the curve. And we talked about this. Risk monitor went green. And I said, well, it's got to get above this yellow dashed line or it's in big trouble. I didn't know how right that was. So it couldn't get above the line. Now it's broken down. So what I will be looking to do now, so those of you who want to know why I'm never really positionally short. I don't short at the beginning of major bear markets because you never know if it's the beginning. So I see this head and shoulders top. I wait for the breakdown. Now it's totally out of control breakdown. And now what I do is every time we run back up to either the 50-day or if we make it to the 200-day, we'll look to put shorts out that we might hold for a series of days or weeks. And we'll talk about that, but not right here. Okay. Couple of thoughts for you that I wanted to share. A couple more thoughts I wanted to share. Here's the chart pattern of Bitcoin's ETF. This is just a moment where I get to say, I'm ringing the bell. When Bitcoin was 65,000, I told you it was going lower, right? Where's Tom Lee now? I've been making fun of Tom Lee for a while now, right? The guy who told you Bitcoin would be 100,000 by the end of 2021, right? Where's Michael Saylor now? CEO of MicroStrategy. I've been telling you for months now that I don't think this Bitcoin sell-off ends until Michael Saylor is not only out of a job, but is probably facing lawsuits. He's levered up a software company to buy massive amounts of Bitcoin. 21,000 is the pain point. Do you remember what I told you a few weeks ago? Bitcoin is going to 21,000. That's a fact. Why? Because the market always takes assets to the pain point. And when you get below 21,000 on Bitcoin, MicroStrategy is in big trouble because all of those loans start to get called in. This is not over yet. I'm going to continue to go out on a limb. This is not going to end until MicroStrategy is bankrupt. He's toast. The sharks see the blood in the water. They smell it. They smell the blood in the water. The sharks are other hedge funds, other institutions that see they can carry Michael Saylor right off the trading floor in a body bag, and they're going to do it. That's what markets do. There's a great book called, they've written a number of books, but the original book was called Market Wizards. Really fun to read, Market Wizards. And it talks about George Soros and Stanley Druckenmiller when they first got started in the business. Let's don't talk about politics. I don't care about Soros's politics now. When he first got started in the business with Stanley as hedge fund managers, they became wildly wealthy and they were unbelievably successful. And one thing they did, if you remember, is they broke the British pound. They smelled blood in the water of a government currency and they wrecked it through the pain point price. And they made a fortune on it. If they could do that back then to a government currency, you don't think they can do it now to Bitcoin? It's exactly what they're doing. Does it mean Bitcoin will never go up again? No, it probably will. Right after they wipe out Michael Saylor, put Bitcoin to, I don't know what the price will be, 5,000, 10,000, I don't know. And then they'll load up on it on its way to the Tom Lee number, right? So Tom's eventually going to be right. It'll get to 100,000 after it goes back down below 10,000. I've seen this so many times before. I was in an Uber car in Titusville going to grab a bite to eat. Let me tell you something. There are not a lot of places to eat in Titusville. Wonderful marina, lovely people. We're in Uber driving through a pretty sketchy part of town. I said to my wife, where are you taking us, honey? She found like the greatest little restaurant, Asian fusion with Mexican. I don't know. It was delicious. Anyway, and the Uber driver is asking me, he finds out what I do for a living. He's asking me what I think of cryptocurrencies, right? So it's still on the mind of everybody. Crypto won't bottom until the Uber driver stops asking me that question. You know what I'm saying? But I told him, and I'm telling you guys, crypto's not going to bottom until it wipes out all of those crypto millionaires who got lucky. Like they didn't understand markets at all. They bought an asset at a time when the Fed was adding insane amounts of liquidity, and it became a casino, and they became millionaires. They had no idea how to protect that capital. They leveraged that capital. They're getting wiped out. So it's going to go down, Bitcoin and all the others, to a level that wipes all of those people out. Then it'll reset. Then it'll start to go higher, because I agree cryptocurrencies have a place in society. Totally agree, right? But you have to go through that wipeout first. It's exactly what happened with internet stocks in the year 2000, 2001, 2002, 2003. You know, people made a fortune on pets.com with a little sock puppet at the, spending millions of dollars throwing away on advertising at the Super Bowl in 2000, right? And then pets.com went to zero. Okay, wiped out everybody. But then out of that, scorched earth situation comes green shoots that are called Amazon, Google, Facebook, some of the greatest investments in the next bull market. So we'll be there to talk about it. I'll be happy to be out there buying them. Probably happens sometime after Michael Saylor is out of a job and dealing with lawsuits. Okay, that's my call. I hope I'm wrong for his sake. I don't wish him ill. Okay, I just think what he's done with the company is, I don't know how aggressive I should get with my language, but it's just tragic. Let's leave it there. I can't believe that he was allowed to do what he's done, and it's going to bury a lot of people. I also want to move on to this Celsius thing. You guys following Celsius? I want to talk about Celsius for a minute, because you're going to see this happen over and over in your life, and I want you to remember it. I hope none of you got trapped in this. If you did, you got to remember it, so you never get trapped in a situation like this again. So Celsius was a crypto story, company, fraud, Ponzi scheme. Okay. I had an investor, ARMR Insider, who was an investor I was managing capital for. He asked me this question. He wanted to get involved in this process of Celsius. This is months ago. This is like 6 to 12 months ago. He told me it's the greatest idea ever. Let's put money into it. They're going to give us a 20% return. So you give them your cryptocurrency. I'm making this simplified so everybody can understand this. So you have cryptocurrency, you give it to this crypto bank, okay? They're going to give you a 20% return interest on the crypto they've borrowed from you, okay? 20% return. Crypto keeps going up. This is the greatest thing ever. I get to take my crypto and get a return on it. 20%. I said 20%. Please don't tell me you're going to do this. No, it's the greatest thing ever. I said, hey, hold on a second. Okay. What you've just described to me is a classic Madoff Ponzi scheme. The only way a company like Celsius can guarantee you 20% return interest on your cryptocurrency is because they're robbing Peter to pay Paul. And when cryptos go down and they can't keep getting people to add crypto to Celsius's network, right? They get to that limit, that Madoff limit, where the new money coming in can't pay off the interest of the old money that's there. And then you get a run on the bank. And then they close it and they say, sorry, you can't get your money out. because there's no money there. They're criminals. I said this 6 to 12 months ago. And now it's starting to happen, right? And they're going to come up with excuses and reasons and whatever. This was, I think, a European company. So you're in the US, you're going to send them your crypto. They're going to give you 20% rate of return on that. You can get your crypto out anytime you want. Right up until the Madoff moment when they can't take crypto from somebody else new to give to you that 20%, right? They can't do it anymore. When crypto goes down enough, it's over. And that's what's happening now. So remember this. You're going to see this over and over again. And I'm going to leave you with this one thought. Nothing in life is free. If you think that the yield of 20% in a market at a time when interest rates were zero, if you think that's a gift, think again. The risk for that 20% is through the roof. That's what you have to understand. It's true on all kinds of investments. I'll give you another example. AT&T stock kept going down like this. Bang, 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 kept going down. Wow, the yield's 8%. Maybe it got to 10% at one point. The reason AT&T was yielding 8 to 10% is because they couldn't fund the dividend and they were going to have to cut it. Then when they cut it to 4.5%, stock started to go up. So when a yield looks too good to be true, it's because it's not true. That's all I have to say about Celsius. All right. That's all I have to say about Bitcoin. I'll be happy to add it to the portfolio at some point, and probably I'm going to do it when Bitcoin's trading below 10,000 again. That's my guess. Hey, I appreciate that, Gabe. All right. Let's get back to portfolio management now. What am I going to be doing with the rest of today going into the meeting tomorrow? All right. Personally, I think the sell-off is over. I think the market probably bounces today into the meeting and probably bounces after the meeting. It wouldn't change the risk monitor green, but my guess is that's what's going to happen. This sell-off is just too aggressive. Hey, thanks for that, guys. I appreciate it. All right. So what's left in the portfolio is really, I want to just go over it real quick. XOP. So there's nothing wrong with energy stocks coming off of a wicked run, pulling back to the 25 to 14-day moving averages. They might get all the way back down to the 50-day, but they're in a wonderful uptrend, and it's probably an opportunity to add to energy positions, okay? Same thing here. it's an aggressive sell-off, and this is just a classic baby in the bathwater, okay? When the market crashes, everything gets sold. Here are the oil service companies. Look like they were getting away from me. They're coming right back in. I'll be able to get them back in the portfolio. Here's AMLP. So those are the 4 big ETFs of energy. Anybody's missed the pipelines. Here's my thought on pipelines. There's nothing on my whiteboard right now. Okay, I'm not interested in buying anything right now. This is risk management right now. This is day trading indexes and volatility and treasuries. That's what I'm going to be looking at today, or I won't be doing anything. Okay. But if I have one thing I wanted to, maybe increase the size of in this market today, it's going to be my pipeline positions on the weakness back down to the 200-day. Let it get to the 200-day, let it find support, let it give us a risk on entry point. Boom, I'll be increasing my position size in pipelines. Pipelines to me are the best risk reward scenario in this market in energy. The best risk reward. I can make more money in E&P companies. I'm not saying that. They're skyrocketing. But for a conservative portfolio at a 7% yield, which is normal for pipelines. So nothing strange about that. If pipelines were yielding 14%, I'd say there's something wrong with pipelines. 7% is perfect. 7 to 8% is what they yield. So when that yield drops below 7%, because the prices have gone up, I don't want to own them. When the prices come down and yield gets closer to 8%, that's when I want to own them. Okay. But we have a major energy problem in the United States of America and around the world. I just took a boat trip to St. Augustine. That was 220 miles, filling up with marine gasoline. Holy smokes. Okay. Let's just say the rest of the summer, we're fishing off the beach. Yeah, kids, we can sleep on the boat right at the dock, right? We own the slip. Let's just go sleep at the boat whenever you want, right there at the dock. And then we'll get up in the morning. Let's get bagels and go fishing. What a fun beach town. It's called Jupiter. Didn't cost a thing. Anyway, what's the essential way to fix the U.S. energy problem? We can be energy independent. I don't know if Joe Biden is going to figure it out and try to fix it before the midterm elections, or if all those people are going to get replaced by energy intelligent. Let's don't even call it Republican or Democrat. Let's just say energy intelligent people, okay, are going to probably get elected in November, right? And what's going to happen over the next couple of years is energy is going to start flowing again out of this country, and it flows through pipelines. Okay, this is the no-brainer long-term story for a conservative portfolio. That's at the top of my whiteboard. I don't want to get into politics, so I'm just going to say this real quick. I'm not going to get into politics, I promise. But we're in this mess because of this wonderful altruistic feeling of let's save, the planet. Okay. I get it. It's a wonderful altruistic thought. I don't fault anybody for having the thought, but we have to be rooted in our economic approach in reality. Okay. In reality, wind, solar, these things cannot replace fossil fuels at this stage. We can work on it. We can get to it. Who knows? 20, 25, 50 years. I don't know. Yeah, and don't tell me the world's going to die before we get to it. That's just a load of baloney to force agenda. Okay? These things take eons to happen. Right? So we need to actually create energy that allows people to get from point A to point B, right? So that they can work on ESG projects. But if the workers can't get in their car and get there because the price of energy is going through the roof, none of those things are going to happen. So let's focus on an energy policy, right? That actually gets people from point A to point B so that then we can figure out how to save the earth. That's all. That's all I have to say. Let's move on. Portfolios. I'm not adding anything, but energy pipelines at the top of my list if I were to do anything. Trading is what I'll be doing today. Oh, let's just touch on precious metals real quick. All right. They continue to confound. All right. But spot physical gold, I'm going to stay in physical gold as long as it stays above this low right here. PSLV, I'm going to stay in spot physical silver as long as it stays above the low right here. So if it's making a double bottom higher low, I'm going to be in it. I removed SILJ because these are small cap stocks and they just can't go up in the market getting crushed, but I might come back. I still own GDX and all of the big cap precious metals miners. If this low right here gives way, I'll get out, but I'm looking for this to be a double bottom. That was a massive reversal on Friday. Then, of course, it gave it all away yesterday, but I'm looking for that to hold. And so we still have our exposure there on precious metals. I think that's it, guys. Just to wrap up, like I said, I'll be day trading today if I can find it. And here's my last thought. Then I'm going to end with this in case you have a question. It looks like it's 9/11. I got to get out of here. When it comes to day trading, this is very important. When volatility skyrockets like this, it becomes very difficult to day trade unless you're scalping. Okay, get in, it pops, get out, great. If you're trying something else, you have to identify a trend and stay in that direction with wild volatility until that entry point fails, right? So we look long the market, and if we can get it in the morning, that trigger bar, the low of that bar is our stop. As long as we're above that stop, we're not looking to short or hedge or anything. If we take out the low of that bar, Then we can flip trade the other way. That's what I'll be focused on. See if I can find a trade or two today to make some money. All right. So anyway, quick questions, and then I got to go. Invest in kayaks. Invest in kayaks, Richard. Seriously. We can go, kids. Grab an oar. Hope they do 75 basis points. Get it over with. Yeah, I'm not even sure that'll be enough, but yeah, I'm with you on that. And Gabe and Derek, thanks so much for that encouragement, guys. I appreciate it. Oh, and then the Dennis was asking a question. Is the market overbought? Is it bloated? Is there more downside? Well, I think we covered that, right, Dennis? So we could talk more on the live trading desk in a minute, but I got to get out of here and set that up so we can all start trading together. All right. So everybody have a great trading session. Don't shoot till you see the whites of their eyes. Take some time off if you have to. If you had a couple of days that really disturbed you, you don't have to trade every day, right? Take a break. Position size is a lot smaller if you want to stay engaged, but make them smaller. These are all ways to participate and protect capital at the same time. I'll see you guys on the flip side.